Today's climate for startups, especially in technologies, is unparalleled to anything we had in prior decades. Born and raised in Cleveland, Ohio, and trying to start a software company in the 80s was something that no investor in Northeast Ohio had any appetite for. I would go home and tell my wife, if I was opening a retail strip mall, there's all kind of partners that want to help. But opening a software company, and so what I actually did was I went out to Seattle, and OverDrive opened a small office in Bellevue, Washington. And because there was so much success around Microsoft and other technology firms in the area, we did our first private placements and raised money from accredited investors because there was already an education and understanding, and many investors had already seen returns and success. So anyone who's starting a technology, a software, a .com, especially if it is a true disruptive opportunity for legacy or other non-digital, non-mobile businesses, I believe has unparalleled opportunity to go shopping for partners in investment. When an entrepreneur or a significant founder or owner is looking to bring in new partners, it could be a partner such as a private equity investor. It could be debt through a variety of debt instruments and facilities. It's important to try and see what is the cost and what is the impact. Now, obviously, when you work with debt instruments and work with local banks and lenders, usually you're going to have less, voices at the table on a day-to-day basis. But you are adding to your balance sheet and your income statement these burdens to now service the debt and disclose and be mindful of leverage that you now added to your operations. On the other side, going out for private equity or smart money, while it may have less impact on your income statement month to month, you're now in many cases going to have an active investor who has their own agenda and their own thoughts on how you should be operating the business, wants a voice in all key hires, and possibly even bigger strategic directions that may not always align with the founder's thoughts on going forward. When a entrepreneur, founder, or significant equity owner of the current business is at that point of possibly giving up significant equity stake or even majority stake in the business, it is really important to realize who has the leverage. Now, I was fortunate that when we went out for our large private equity round in 2011, I already had many years of strong double-digit growth. We had recapitalized the business in prior years so that we had all the preferred, no debt, everybody was in common shares, and I had a track record of several years of strong year-over-year earnings. We also took the step to invest in several years of audited financial statements. So when we entered the process, I was in a strong position. This allowed me to pretty well dictate the process, who we would interview as potentially representing us as a boutique bank to help us get a process, being able to even articulate only the companies that I approved that I wanted to provide either a teaser or information, and certainly protect access to our information. I really wasn't excited to have one or two direct competitors sign an NDA and then have access to some of our confidential deal book information. So it all depends on the position of the company. And we did this specifically. We waited a few extra years to be in a very strong position, then knowing we could command much better set of terms, valuation, and the ability to kind of set the framework for if we are going to bring in a private equity or venture partner, these are our criteria. And I was very fortunate that we were able to, and it resulted in a great outcome.